Okay, good afternoon. Welcome to the weekly take on the market. I will be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Please take a moment to read the disclaimer. I'm not licensed. I can't tell you what to buy, what to sell, what to hold, what to do with your 401k, how many ETFs should you hedge, et cetera, et cetera. One of the great perks of working here, I know I've mentioned it a million times, is it's truly being able to have skin in the game and feel the joys and sorrows that you guys feel along the way. Uh, and I know it's been probably for most people a couple of tough days, but we'll get through it. These days come and go. Maybe the good news is farther away than we'd like, but every bear market, every correction leads to another uptrend eventually. There aren't any stocks to watch, obviously. The good thing with this correction or bear market or whatever you want to call it is you can kind of go back to the basics. You can wait for cups with handles. You can wait for double bottoms. You can wait for flat bases. You don't have to get tricky. You don't have to buy any undercuts of lows, I don't think. You don't have to buy off the moving average. I tried that one last time a few days ago, and it didn't work. Today, BABA, for example, I bought off the 50-day and then got stopped today. So back to basics makes it real easy. I'm looking for patterns, and that's going to take a handful of weeks. And then as far as the market, obviously, we have our system is outlined in Bill's book, How to Make Money in Stocks. So I'm going to really talk a little bit more about philosophy and the indexes more here. I'm not going to do industry groups, not going to do any individual stocks. And then I'll go to the quote of the week. So as far as the indices, these are some of the things that I've, it's been a couple of weeks. I showed this tweet, or I cut and paste this tweet, and I apologize, I don't know who tweeted it, but you can see the source down below. I believe it was Macrobond that must have tweeted it. Anyways, they're the source, about how if you just get out below the moving average, the 200-day, and get back in when it comes back, the outperformance. And it's a little bit, according to a really good friend of mine, Johnny, who does really good work and studies this stuff. He shared this data with me, and he says, with all due respect, it's a little bit of garbage in, garbage out, because he thinks you're assuming that you're getting in the day before it crosses over. So if it crosses above and is up 3% that day, you can't get in right at that moving average, right? So that makes it real tough. So here's that line. If you were able to do that, if you were able to ignore slippage and getting in, and I apologize. And what's below is what he did, the true measure of buy and hold. And I apologize. One quick second. Please go grab a cup of coffee. All right. Sorry about that. Long story short, life got in the way for a second there. I apologize. So back to this chart. This is what Ajay has studied, and there is some outperformance. You can see that, but it's pretty tough to. I'm sorry. It according to Ajay, just buy and hold works better because you don't have that slippage versus the long above the 200-day moving average. So I thought I would share this with you guys. Didn't want to lead you down the primrose path that there is some magic bullet that you just buy above the 200 and sell below the 200. One thing about it, I'll push back just the slightest bit because I know Jay's done the math and he'll probably watch this. So the math is the math. But for me, it's about the psychological value I think, of giving up a little bit of the gains if you were to do something like this, and avoiding those really bad downdrafts that might get you to do something, panic at the lows in a buy and hold strategy. So I know myself. I can't. I don't even like stocks go down a single day. So I would never be able to do a buy and hold. I would panic. Each day I held, the more it went down, the more likely the pressure would get to me, and I would panic at the wrong time. So I would probably be willing to give up to reduce some of that volatility. You can see that, and I'd have to ask Ajay. Maybe he could do like a regression analysis or something those smart people do. And it just looks to me that it's a little bit more it's a smoother ride, even though you give up some of the returns. And I've talked about this before. Would you rather make a smooth 12% or a bumpy 15%? I think this is a Charlie Munger quote, and Charlie Munger says, I'd rather make a bumpy 15%. And I honestly believe most investors would rather make a smooth 12%. Because they're just not going to be able to stomach the bumpiness to get that 15%. So I wanted to share this with you and basically show you that, the work that my buddy Ajay does. And I apologize to Ajay. I should have put his Twitter handle on here, but he's a longtime market operator based in New York, and super sharp guy. And anytime he gets to California, I love to meet with him, and we talk shop. All right, so there's that. Okay, a couple of other things that I found. I found this very interesting: record inflows into U.S. stocks this year. Now, it's not adjusted for inflation or anything like that, but you can see that money's been chasing U.S. stocks because of the performance. And I think I mentioned previously that I think it was Dan Rasmussen of Verdad Capital who said, like, I don't want to, I'm going to butcher the number, but like 60% of the exposure in the 401k industry in Japan is in US stocks. I don't remember what the number was, but basically he was just like, the whole world is long US stocks. And it finally came to a head in this little sell-off here that there's just, we've kind of come to the end of the road as far as the last buyer. There's nobody left to buy. Talk about that with the the sovereign wealth funds being all loaded up in NVIDIA, et cetera. And so and it just took like a forest fire. It just starts, and it just the tiniest spark. Some guy forgets to put out his campfire, and you have a 700-acre forest fire. It's just kind of what it takes. It just takes the littlest spark to start a gigantic forest fire. And this has been a forest fire. This has been one of the worst tapes I've seen in a long, long time. I mean, there just is no lift at all to stocks. I think it's one of the worst 2-day periods in stock market history, in fact. All right. So here we are again. The world has a lot of tied up capital in the US. What if investors take profits? Yeah, what if? We're starting to see the what if. In January, Goldman Sachs surveyed their clients at their strategy conference. In the 8 years of results, the firm published a share expecting the U.S. to be the world's best performing region for stocks was the, drum roll please, highest ever. So coming into this year, everybody thought, well, the U.S. is going to outperform because they just extrapolate what the market's doing. If it's up today, it's going to be up tomorrow. If it's up in April, it'll be up in May. If it's up for the quarter, it'll be up the next quarter. If it's up for the year, it'll be up the next year, and so on and so forth. And finally, the boat just got a little too heavy on one side. Okay, so this has been a fly in my ointment, to be honest with you, because this has kept me from reading the tape. I've had desperate desire to be really short here, and I just haven't been really short because of the sentiment. And then maybe a week or so ago, Jason Shapiro, I don't know if I mentioned this previously, said, maybe everybody knows that everybody's bearish, and therefore it's not a good signal anymore. And it just was like a light bulb to me that, all this information gets out there so fast nowadays. So here I am on my video telling everybody that AAII is bearish, and it's all over Twitter. And so maybe it's not valuable information. I don't know. But he also said, are they doing what they are saying they're doing? And I don't know how they're measuring this, but I do see stuff on Twitter where like retail was a net buyer yesterday on Thursday, like a really big buyer of stocks yesterday. Retail investors are. So if that's true, and I have no reason to argue that it isn't, they've been trained to buy these dips. These dips, the market comes back fast. COVID trained everybody that, boy, you get into a big sell-off, you should buy that because it's back to new highs in just a couple of months. And my gut instinct is that won't be the case this time. I don't know. I'm open to it, but it just seems unlikely this time. Or maybe it's got to go down a little bit more to shake the tree and get them out. They really haven't. A couple of people have asked me about, what do you do in a 401k in a market like this? And, I think there's two strategies. Bill's strategy with mutual funds is you just constantly just buy it. I think there's a chapter in his book, it's underrated chapter. Nobody talks about it much. And actually, if I could go back in time in 25 years or 30 years of trading, it's one thing that I would do differently is buy mutual funds in a separate account. If I had a good year, put a little bit of the profits in a Fidelity Contra, lock it in a drawer and forget about it. I don't want online access to it. I don't want any of that. And then the next year, if I have a good year, take a little bit of profits, buy Fidelity Contra, and just so on and so forth. I can only imagine what that account would have grown to. Now, I don't know if I'd have survived the financial crisis because I talked about the emotional. Let's say I had built that to $1 million. And in 2008, when everything's coming down, and I probably would have looked, to be honest with you, oh my God, it's down to 650. I probably would have panicked out. But who cares? It'd still be 650 or right there. Maybe I had the gumption to get back in after it's rallied 100 grand worth of stock. So anyways, the mutual funds, I'll read Bill's chapter. I would just do that, the 401k thing. And then there's another Wall Street saying, because I got some calls from friends, or I haven't done anything with my 401k. It's too late. It's too late. It's too late, isn't it, Scott? They want me to tell them that it's too late to do anything. And I always tell them incremental. Don't try to get all the way out of it or all the way into it. You're going to put too much pressure on yourself. So I talked to a friend yesterday. In fact, just said, what if you sold 10% of it and you just felt better? What's the sleeping point for you? 10, 15, 20%. And I said, I want you to imagine that you sell 20% of it. I want you to do the math. I sold 20% of it, and it's the absolute low. And the market makes a new high the very next day, an absolute new high the very next day. Well, what did you give up, right? Remember, you still have 80% that went up. You still own that portion. So it was almost like an insurance policy. And then I want you to do the math that the market goes down another 50% and say, okay, what did I save there? And did I do enough selling? So you have to be willing, you have to build these scenarios in there, because otherwise when the time comes, you're just going to freeze, as I find most people probably are. I got a lot of texts and messages yesterday and today from friends that invest through 401ks and what they were doing. And overall, I don't know, take it for what it's worth. It's just anecdotal evidence, but they aren't getting out. They see this, most of them see it as, an opportunity. So, and they've been right for 25 years, 30 years of investing in the 401k. I've always been the boy who cried wolf when I tell them about protecting yourself to the downside. All right. So let's open up the industry groups. I'm sorry, not the industry groups, the indices. Let me make sure I'm sharing right. Okay, so here's the S&P, and I don't know. I mean, look, it looks very climactic in the short run, but I mean, it closed right on the low into the weekend. Not for me. I mean, if can it open up 100 S&Ps Monday? For sure it can. Could it open down 500 S&Ps? For sure it could. It could do anything Monday. And so to me, there's no edge. There's no risk. The risk reward is totally impossible to evaluate. And so I'm 92% on the sidelines. I have an 8% short position that I just don't want to cover. I don't know why. I'm just trying to stay the course in it because I think it's got a lot more downside, but it's 8%. So if it opens up 10% on me, which seems unlikely because it's a big cap, I'd lose 0.8%, right? So I just think sidelines is, for me anyways, and for most people, is the best way. And honestly, I should have been sidelines here. I was buying. I mean, Baba. I bought Baba. I bought it and it closed really well. And this is the lesson I'm going to talk about with a quote. Right or wrong, I got fooled a little bit by the strength in the stock. The stock was acting so well in the face of the bad market. One, bad U.S. market, and two, I kind of feel like the Chinese stock market has had its bear market already. I've talked about that. If you go to a monthly, I mean, this is, I don't know what that is. It's 50% at least, and it's not even close to these all-time highs. So I thought, well, it turned out to be wrong, but this is what I reasoned why I held it, is that it could withstand the U.S. storm. And then, really, if the U.S. kind of stops going down, then I really felt like it could do that. And maybe it still could. I don't know. But I had to get out today because I just don't want to risk it. I mean, again, what I talked about in the market, S&P could be down 500 handles on Monday or up 500. We're in total no man's land right here. So, I mean, it looked like an okay close, but then I was like, well, that's with the gap. So I actually did this. And now I was like, does that look like a good close? No, it looks pretty bad. So even if it had opened unchanged and did that, I would be a seller. So I'll reevaluate. Maybe I'll go back to it. Maybe I won't. I don't know. But it's right or wrong. Again, for me, this has reinforced why I am a trader and I take profits. I was selling some of my Baba there. Like literally just, hey, it's too good. Everybody sees it here now. It's time to go. And I couldn't bring myself to get out of all of it. And I kept some of it. And then I added to that what I kept there. And I got hit hard on it today. 10% position down, basically 10%. So I lose 1% of my whole account. But for me, that's 1% across my entire liquid net worth. So I don't know why, but it hurts. It hurts. So that's how I handle it, right or wrong. And so but the market, I should have listened to the market, and food for thought. All right. So the S&P, the NASDAQ, I can't look any different, right? Looks really, I mean, you've undercut these lows, I think. Did you undercut that low? 1570? Yeah, you undercut that. So you just got everybody, all the institutions, all the hedge funds, all the 401k money is all underwater here. Now, undercuts usually give you a chance to rally. Like, look at this undercut, right? You're undercut, you got a little rally. They usually get a rise. So if we open down tomorrow or Monday, you probably could see something like that. It seems likely, but I just don't know how you can position for it. So for the average trader, I'm talking about traders, you should be almost all cash, I think, right or wrong. Even though, it seems like we're getting into that point where, when they start the waterfall decline like that, like here, you can see a bounce is almost always inevitable, but the environment seems a little different right here. And these bars, like this is down 1%, this is down 2%, that's down 1.79%. I mean, this bar is down what? 5%, 6%, and 6% almost 12% in 2 bars. You're just in like no man's land. Unprecedented, unusual. I don't want to use the word once in a lifetime action, but this feels very, very much like those really bad periods where there just are no buyers. So you're better off just letting the dust settle. And if you have to buy the NASDAQ, here, so be it. If it's 6 months from now and you're buying XYZ coming out with a cup with handle or double bottom or a flat base, you're going to just be so much better off, I think. And I'm talking to myself too. So NASDAQ, I mean, where do you hide? You're just in cash, which is the bond market. You can see it's trying to go up, and I think 0TVX is a 0TNX. So this is the yield, right? So you can see the yield's gone from 4.8 down to 4. It's actually made a pretty good move downwards in yield. So you just sit in money market, and nowadays you make 4%, which is 5 years ago we made 0. So you also you win by not losing. So every dollar not lost is a dollar gained. And last but not least, you protect your mental capital because you'll be there for when it turns around. And a lot of other people, if this goes on for a long time, they're going to get so beat up, they're going to lose that mental capital. I mean, I can tell you, like today was a total mental capital drain for me with the day I had. Like it really just like, it just takes the starch out of you and the lack of, I just don't want anything to do with the stock market. I don't want to look at stocks. I don't want to do any work this weekend. I just want to like crawl in a hole, right? And just lick my wounds. And so you don't want that. And that's just one day for me. If I have 5, 6, 7, 8 days like that, they just start to pile on or weeks or months, and you'll lose the gumption to be there when the market finally rights itself. So that's one of the advantages that we don't talk about too much is that protecting yourself in that regard. NASDAQ, S&P, what about like gold? So in the end, when people are getting hit everywhere, they'll look for a place to hide, and they'll look for liquidity, and gold has it because it's held up really well. I find it very interesting. Wow, look at silver. So it couldn't go up, right? And everyone's saying, "Well, silver goes up more when gold goes up." And even I was saying that, so I bought silver here. This breakout, and apologize, I'm a little under the weather too. And I don't remember if I bought it here, but they just it would go up and it can't continue up. So I'd buy it and it was a stall. So I'd get out and I'd buy it and oh no, I know where I bought it here. I bought it there and got out for the tiniest gain or tiniest loss, and I bought it this one right there and got out for the tiniest gain or tiniest loss, and it just kind of gave up on it. Bitcoin, I think it was up today because I saw on my screen MSTR was up, so Bitcoin was up, but that's it. So now, okay, I know what I want to talk about. A lot of people have been asking me about the follow-through day. Don't make the follow-through day any harder than it is. It's a very simple concept. Look in Bill's book. Look at historical follow-through days. He'll show you this is a follow-through day. The volume is up and the index is up 1.some% or whatever. So I know IBD talked a little bit about like a follow-through day in spirit, and I apologize, I don't remember the day. Was it this day right there? That seems likely. up 1.76%. And we didn't get the volume because of the triple or quadruple or whatever witching it was the previous Friday. So we were on the fence. We didn't know what to do. When I say we, I mean the markets team, IBD. And so there's a lot of people like confused what to do, but I would say, let's pretend it was like a outright perfect fall today. It had the volume was up and it fit all the characteristics. What was there to buy? Was there any cups with handles, any double bottoms, any flat bases? No, not a single one that I can think of. Maybe I'm wrong, but let me show you what happens in a real fall today. So this is how you'll know. I think I can't remember what month it was. Here it is. Okay. So it was 9/1/2010. And the only reason I remember this one so clearly, is I had just started at IBD on the Marcus Smith team, and Scott O'Neill was the president of Marcus Smith at the time. And I think, I don't know, I think I'd started somewhere in there. And so he would come out a lot and talk to us. We'd have these, what we would call huddles, which are really cool. He'd talk about markets, talk about stories with his dad, when it was quiet, talk about what the portfolio managers were doing. He'd come have Charles talk to us. He'd come have Steve Birch talk to us. So that was kind of a cool thing because we all sat in this hallway and he'd come down there and we'd all sit around and listen. And on this day was a follow through day in the market. And guess what? So there's a follow through. What's there to buy? Well, Chipotle is breaking out of a cup with handle. Look at the volume. Look at the base. Look how strong it is. What were the earnings and sales like at the time? Well, I don't remember, but they were really strong, like 30% or whatever. If I go, what year is that? 2010. Let's go to like the. Oh, it's so far down. It's not even on there as well. So. But I can tell you it was really good. And me and Arusha, you want the story or the narrative? Me and Arusha would go there almost every day for lunch. And they opened at 10:30 or something, but we'd always go at 10 and be there by like 10:20 and they'd let us in. And we were always one of the first ones there. Otherwise, if we were late, there's a big line. And so it breaks out a couple of handle and goes up, 12 weeks in a row or something like that. And Bill was in this. And so when it was breaking out that day in the morning, you don't know what to follow through day. Put the index across top. But the market's rallying. It could be a fall today. You can't confirm it till afterwards. But if the market's up 1% or more, then it could be a fall today. And is there anything to buy? Well, guess what? Chipotle. So they're not waiting till the end of the day, the portfolio managers. Scott came out about halfway through the day in the morning and said, we are buying Chipotle. And when he said we, he meant the portfolio managers. Now they all sit separately at that time. None of them they all had their own offices, Charles, Mike, Scott, but they were all simultaneously buying the same stock. Why? Because they'd done their work. They could see Chipotle showing up on all the screens. The relative strength line was at new high at the time. The earnings and sales were there. And Bill, he was loaded up in it. This was Bill's biggest position at the time. So it should be almost that easy. I don't want to say it's easy, but it should be almost that easy. If you have to force feed it, then it's probably not a real follow today. So they're not all going to work, but there should be something to buy in combination with a follow through day. So I hope that helps for a lot of you that have asked about the follow through day. The good news is, we're back at square one. So we're here on the NASDAQ or whatever. And as soon as we undercut these lows, you start the count all over. Even if it only undercuts by a penny intraday, the old school rules is undercuts the low, boom, you start the count over. So this was day one. This was day two. This was gonzo. We've undercut the low of the move. Therefore, we start the count over. So we're at 0. So if Monday is blue, that would be day one, day two, day three, Day 4 goes up 0.5%. Is that a follow through day? No, not enough. You want power. It should be up a lot, like 2-3%, something like that. It should be real power. Day 4, day 5, day 6, day 7. We go under these lows on day 12. What happens? We start all over again, back at this low. So if we make a low tomorrow, let's say we do this, and it's red, or if we do this and it's up a penny, so it's blue, that would be day 1. And so as long as we don't undercut that low, we would stay in the count 1, 2, 3, 4, 5, etc. Again, don't make it any harder than it is. If you do some research with old follow through days, and then in the end, if you just read the big picture, I promise you, they're going to tell you it was a follow through day. But there should be some things to buy, in my humble opinion. So, all right, there's those two things that people ask a lot about. All right, so let's get to the quote of the week. And I was going to tweet this morning, and maybe I will tweet it, but anyways, one time, I don't remember which workshop I was at, and forgive me, this is as best as I can recall. So I don't know exactly how Bill said it, but this is what he said. He says, I sometimes think I should have put the M in front. It is that important. And the M stands for the market in the acronym Can Slim from the book. And me and Arusha were joking. We were making up acronyms. I think the one we liked the most was MANSLIC, MANSLIC, right? So instead of Can Slim, we would have called it MANSLIC. And we were joking about and thought it was fun and making up all these acronyms. But today it really hit me because I kind of was ignoring the M by holding the BABA. The M was screaming at me. Every day I was constantly looking at the markets like, gosh, they are so poor. This is really putting some pressure on me. But BABA kept holding up. It was acting well. It would close really good, et cetera, et cetera. And in the end, they just get them all. The M is that powerful. So I'm not very good at the M. The M is always tricking me, unfortunately. But you gotta pay attention to the M. So I think maybe I just got to get better at the M. I don't know. I don't know what else to say about it. Because I for the longest time, I've ignored the M and just focused on the stocks. And that has worked and worked and worked. And, this is just a single incident with the today's action where that hurt me to do that. I was focused on how well BABA was acting, and I was trying to ignore the M. So most people aren't ignoring the M. I know a lot of the guys in IBD Live watching on Wednesday, Thursday, and I didn't watch this morning, but they were, I'm in cash. They were all saying, I'm in cash. I'm in 98% cash or whatever. So they're not ignoring the M. I was trying to hold BABA for a big win, and it didn't work. And it just, I don't know. I know that they're out there. I know that people have bought NVIDIA at 100 and rode it to 600 and bought Home Depot and Apple and Google. And I know it has happened. It just doesn't happen for me. What happens for me is that when I try it, this is what happens. They round trip. So I just am better off just taking pieces and just stair-stepping my account. It's just psychologically, I just like it better. And it just seems to, I don't know, I can't explain why, but it is what it is. It just seems to be the way that I'm wired. Maybe it's the stocks that I'm wired to pick. Why did I pick BABA to do that? Why not Meta or Tesla or NVIDIA? I don't know. So I can't explain it. I just know that I'm better off in that 20 to 25%, whatever the number is. It's actually honestly more like 15 to 35% range where I get into those ranges, and I'm looking to reduce and exit the positions, right or wrong. Know thyself is another great quote. Well, the real quote from the market is, and I've used it before, if you don't know who you are, stock market's an expensive place to find out. So maybe this is the low for Baba, and maybe 6 months from now the stock's at 145, and those that can hold through that, they did just fine. But I know myself, and I can't do that. I'll panic. I'll get out on the first sign of unusual weakness like today, and so I'm better off taking it while the going is good. I'm going to leave it there. 800-831-2525, market surge at investors.com. Have a great weekend, and we will see you next week. Bye, everyone.